Good morning and welcome to the Financial Brokerage webinar, Refinancing Mortgage Insurance, a new look at an old concept with myself, Brian Lysing, as your host. And as a reminder, we have everybody on mute this morning, and your questions can be typed. You can do that at the bottom of the control panel on your screen at any time, and we'll review those questions at the end of the webinar. I'd like to thank everybody for joining us this morning and taking time out of your busy days for a sales idea that, hey, we hope will make you a lot of money in the year to come. We're going to talk about, like I mentioned in the intro here, an old concept. And let's see if I can get the computer to work right here. All right, well, we'll just start right here. Mortgage insurance usually refers to a life insurance policy that a person bought to pay off their mortgage if they died unexpectedly. And what we're going to do this morning is discuss some ways to make this a better product for the consumer and also make the sale a better sale for you. And I'm going to start by talking a little bit about the marketplace. And this is a market that's coming back right now. I like to think of it as a re-emerging life insurance market. 5, 6, 7 years ago, we saw a lot of business being written in this market because interest rates were extremely low. Everybody was able to get a mortgage or refinance and save some money. Well, look what's happened here in the past year or so. Interest rates have recently hit all-time lows. This was the case last spring when I put this together, and I just saw an article on Yahoo News yesterday that said 30-year mortgage rates dropped yet again. So this continues. People are able to refinance and save money on their mortgages. People are also buying new homes. I know earlier this year we were on pace for a number of 5 million new home sales this year in the United States. And on top of that, we've seen over 3 years, it's probably now over 4 years, of positive job growth. So people have got jobs, they've got the disposable income to move around again or to buy a new home. So that gives us, all of us in the life insurance industry, a tremendous opportunity here. Now, the need, well, we know that a mortgage on a home is the largest source of debt for most Americans. That is still the case. And, of course, paying off that mortgage in the case of an untimely death is still one of the most common reasons people buy life insurance. It's a lot easier sale to make to get life insurance to cover a person's mortgage. You don't have to go into nearly as much detail as you do for even a simple income replacement sale. This is something tangible. People live in it. They can touch the building. They know they need to protect it. And so this is probably one of your easiest life insurance sales out there. Now, what happens when people come across these sales opportunities? Well, here's a typical solution to a typical case out there. If your client borrowed $250,000 and they took out a 30-year loan, you might offer them a $250,000 30-year term life policy, and that takes care of the need, right? We covered the full amount of the mortgage for the entire length of the mortgage, and that takes care of it. But is that everything that you could do for your client? Well, what if you've got a client that's on a really tight budget? They need to save some money. You ran that 30-year quote for the full amount. You run the spreadsheet comparisons. You've looked at everybody under the sun, and you're offering them the lowest price. Well, is that really the lowest price? Could you do something else to lower the price even more? Well, what people typically do is lower the face amount. Now they don't have enough coverage, or they dial back the term length. Now they still don't have enough coverage. So that's really not doing your client justice. We'll discuss some ways you can lower the premium without cutting out the proper amount of coverage for them. Now, what if you have a client who maybe they're not on such a tight budget, but they're concerned about paying the mortgage, not only if they pass away, but what if they get sick? What if they're injured? What if they're unemployed? They can't work, and income isn't coming in anymore. All of these are actually more likely scenarios than death. What can we do to help those people? And third, we're going to discuss what if your client would like to pay off their mortgage early. They've got some extra disposable income. I mean, who wouldn't want to pay off their mortgage early, right? That's usually the biggest expense we face every month. We'd love to not have that bill coming in our mailboxes every month. So we're going to discuss 3 main areas. The first area will help your clients save some money by lowering the premiums. The second area will provide your clients with money through living benefits. They don't have to die to receive these. And the third area, we'll actually make your clients some money so they can pay off that mortgage early if they decide that's what they want to do. So starting off with the first area here, we're going to discuss a couple ways you can help your clients lower premiums on these policies. And we'll do that a couple different ways. One is by exploring what I've called the new decreasing term life policy. And then also we'll discuss the concept of laddering policies. Now, the decreasing term concept, this is something that people used to sell years ago. I haven't seen a company offer this in probably 5 or 6 years. The premiums had gotten to the point where a person could buy a level term policy for less money than they could buy a decreasing term, just because of the lack of competition. So why wouldn't you buy the level term policy? But the principle of it was that, as a person's mortgage balance decreases, the life insurance coverage you have decreases to match the mortgage amount. A great concept. People don't like to pay for anything more than what they really have to. So people still like that concept. Well, here's how we can do it today. I'm going to make some assumptions here that the following numbers will be based on. We're assuming a 30-year mortgage at 3.5% interest, a 40-year-old male in great health. And when I crunched the numbers, turned out that traditional type sale, SBLI, had the lowest price on a 30-year term. We're going to compare that to what you could do with Protective Life's Custom Choice UL. Now, these are ULs. They're filed as permanent insurance, but they function a lot like term policies. And you'll see on the next slide how this really works. So I'll explore the columns with you here. We have this person who took out a $250,000 loan, and you can see under the principal balance, I chose a few years in there, used an amortization calculator to figure out what they still owed on the principal. Now, your typical sale, the person would go in there and sell them $250,000 of 30-year term. And SBLI returned the best price the other day, $337 a year. Well, what if they say, that's too much, that doesn't fit in our budget, we can't pay that, we're going to go talk to somebody else? Well, they're not going to find a better price with that somebody else either if they actually do it. So here's what you can do. If we propose to them the 20-year UL from Protective, we do have to raise the face amount up to $260,000 to make it work. But we're covering the principal balance. In year 16, we still have enough to cover the principal balance. What happens with this product is in year 21, the client has the option of continuing to pay the same premium they've always been paying, but their face amount will drop to match the premium. And every year, because of the cost of insurance charges, the person's getting older, that same premium will buy them less and less insurance. Normally on term policies, you get to the end of the term and it turns into an annually renewable term. You keep your same face amount and your premium goes up and up and up every year. Now with this product, they do the reverse. Premium stays the same, your face amount goes down. And I've crafted it so that we always have enough to cover that remaining principal balance. Or we're pretty close. At year 21, the first year that the face amount drops, we've got enough to cover. Year 26, we're pretty close. I'm sure they could come up with another $3,000 if they needed to. And of course, by year 30, hey, we still have some coverage, but we don't owe anything on the house anymore. And look how much that saved our client at the bottom there. We saved them about $110 a year, and they had a little more coverage to start out with. I mean, who wouldn't want to do that if they're looking to save some money? I guarantee you, nobody else that you're in competition with is presenting this idea to your clients to fill this need. Now, if $227 is still too much, we can take it one step further. We could look at the 15-year product. We have to start out at $300,000 to make it work in this particular case. But if you look at year 16, client's got $190,000 of coverage. They only owe $148. Year 21, $109,000 of coverage. They owe $103. Year 26, we got about $500 more than what the principal balance comes to. And now the client only pays $189. That's just amazing. If your competition is showing your client $337 to cover the mortgage, you're showing them $189. Guess who's going to make that sale? And it's not going to be the guy across the street, that's for sure. So that's the concept of what I call the new decreasing term. Now, you could use that. That won't work every time, though. Sometimes you might need to look at laddering policies. Now, banks do this all the time with their CDs, and when they come due and when people can take the money out, we just apply the same concept to term life insurance, and we're going to layer multiple term policies of different lengths that will drop off as that particular need goes away. And in the course of doing so, we're going to save your clients a lot of money. Similar assumptions here. We've got the same Preferred Plus male, age 40. This time he's got a little bigger house, and the mortgage amount is $500,000, and our base product is once again SBLI. They're very competitive on a 30-year term, and we mix and match different carriers here for the other amounts. And this will all become a little clear once you see the spreadsheet right here, laddering in action. On the far left column, we've got our mortgage balance right there, $500,000, and I chose a few key years to show what that will drop to as part of that principal is paid off. And I've also shown the total coverages that are available with the laddering concept right next to it. And you can see each and every year we've got enough to pay off the remaining balance. Year 21, we're a little bit short, but again, we're pretty close there. Third column over, we've got our typical sale. 30-year term for $500,000 is going to cost this guy $615 a year. Every year for 30 years. By the end, he's paid in $18,000. Now, look what happens when we ladder these policies. We start off with a little higher premium early on, but by year 11, we're saving him money. Year 16, we're saving even more money. Year 21 and beyond, we've just about cut that premium in half. When it's all said and done over 30 years, we've saved our client about $3,000. Now, who wouldn't want to do that? The four columns on the right show how this works. We've combined 4 different term life policies here, a 10, a 15, a 20, and a 30-year of differing amounts. So we start off with the full $500,000. Year 11, our 10-year term drops off. Now we have $400,000 of coverage. We have enough to cover the remaining mortgage. Our 15-year term drops off next. In year 16, now we're down to just $300,000 of coverage with 2 policies. Guess what? We only owe $297. And in year 21, our 20-year term has now dropped off. We're left with the $200,000 of 30-year term. Guess what? That's going to be enough to pay off that mortgage almost in year 21. And certainly in year 22, we'll have enough to cover the entire thing if the client passes away. And again, we saved them $3,000 almost over that 30-year time period. I mean, who wouldn't want to do that? So it takes a little more doing on your part, but you can certainly save your clients a lot of money with either one of these concepts. Now, moving on to the second concept, we're now assuming that we don't have a client that's a penny pincher, and they are very much concerned about other things that might happen to them during this 30-year time period or 20 or 15 or whatever the length of their mortgage happens to be. And I'm going to discuss 5 different riders that different carriers make available that you could put on, really any one of these life insurance policies that we discussed earlier. Now, why are living benefits important? I stole some of these statistics from our friends over at Assurity Life, and they were kind enough to say, we don't care if you use this. Please use our name when you do. So these come from Assurity Life, and they inform me that 60% of all foreclosures in the U.S. are due to a medical condition. It's not that the person passed away. They've got some medical condition. They're still alive. They still have bills coming in the household. And 4 questions you can ask your client to help make this sale. Have you known anyone who has had a heart attack, stroke, or cancer? Who hasn't known somebody like that unless they've been living under a rock their entire life? We all know someone who's had one of those conditions. Was it expected? Nobody expects this to happen. Did it cause financial stress? Look, unless your last name is Gates or Buffett or Trump, this is going to cause some financial stress. I don't care how much other insurance you have, you're going to be paying something out of pocket that you didn't expect to be paying. Would a check for $20,000 have helped? Absolutely. I don't know of anyone who's going to say no to that question. Every little bit is going to help in that situation. So what are the 5 riders we could put on these policies to help our clients just a little bit more? Well, a lot of carriers offer a disability income rider, and it's going to pay the insured's mortgage bill if they're unable to work due to illness or injury. It's a little different than your typical disability policy, which will reimburse for income. This is usually meant to just pay that mortgage bill. We have a maximum of $3,000 a month, and it's usually based on a percentage of the face amount, typically 1.5%. The client can choose to purchase less than that if they want to as well. 90-day limb and 2-year benefit seem to be the standards on these type of riders right there. So a few carriers make that available typically on simplified issue non-med term policies. Critical illness rider is something else that we're starting to see more of these days. They pay a lump sum to the insured in the event of a major illness. It would be that heart attack, stroke, cancer that we all just realize that we all know someone who's had one of those things happen to them. They work a little bit differently depending on the carrier. Some will reduce the death benefit. Others keep the death benefit intact while making additional payments to the client in the event that that happens. A few carriers now offer long-term care riders, primarily on permanent plans, but we're starting to see this on term insurance as well, and these will accelerate the death benefit or a portion of it to the insured for long-term care expenses. Now, this fills a real important gap that isn't covered by traditional health or disability insurance, and I like to think of this in terms of a car accident. If a person's hurt in a car accident, they might have a few, in the best case scenario, a few cuts and scrapes. They need to go to the doctor, maybe get some stitches. Your health insurance is going to cover that. Now, what if you're hurt a little bit worse than that, and you're hurt so bad that you just can't make it into work for a period of time? Well, that's what your disability insurance is for. And I'm going to skip over one step here, but you might die instantly. Your life insurance policy covers that. But what if you didn't die, but not only can you not go into work for a little while, you can't even take care of yourself? Well, long-term care is the only thing that's going to cover that for you. And we can put that on a life insurance policy right now to make sure that your family doesn't go broke because you need long-term care. And a lot of people are gravitating towards these life-based policies anyway because they know the premiums will never change. They are guaranteed. You can't have a rate increase on one of these products. And also, clients know that a benefit is going to be paid out. They don't have to worry about paying in premiums for a long-term care event that may never happen to them. That's fine. If it doesn't happen, count yourself lucky. The death benefit is still there and will go to your family if you never use the long-term care portion. We've got one carrier that offers a unemployment waiver of premium rider. If you're unemployed for a period of time and qualify for federal unemployment benefits, the carrier will actually waive your life insurance premiums for up to 6 months and give you some time to get back on your feet again. And this is really important. We all know that one of the first things to go when a client is unemployed or faces some financial hardship is their life insurance policy. We've all seen policies lapse because of this. Then it's a little tough to go back and rewrite them a year or two later. There's no need for this to happen if they have this rider on their policy. And another very unique rider, this is offered by Mutual of Omaha only. It's a residential damage rider. We're talking about protecting people's homes here anyway. Why not sell them a policy that will give them a little extra money if their home sustains some damage? Now, their homeowner's policy should take care of the repairs, but you know what? If you've got a big hole in your roof, you're likely not going to be living in that house for a while. You're going to have to pay rent somewhere, pay for a storage unit somewhere for your stuff. There's a lot of other expenses that will happen. Wouldn't it be nice to have a little extra cash while that home is being repaired at that point in time? So 5 additional riders we can put onto these policies and give our clients a little bit more value than just the death benefit there. Now, looking at the third concept here, we've got a client with a little disposable income, and they say, well, we'd like to protect ourselves in the event of an untimely death, but we'd really like to pay off this mortgage early, and we'd like to be able to get rid of this portion of our life insurance. Well, you can do that, and we'll discuss a couple ways. One would be overfunding an index universal life policy. Something else I think a lot of people don't even consider is looking into a return of premium term policy. You don't have to cover that whole 30-year period of time. You can do it a lot of times with a 20-year or maybe a 25-year return of premium policy. So here's how the two concepts work with the index life. Client simply pays in extra money into an index life policy, and we'll show you in the next slide here how you could accumulate enough to pay off that mortgage early. And I took these numbers from our friends at Aviva Life. Here are the assumptions that they used in putting this together. And here's how it works. We've got a mortgage balance in the second column there of $246,000. We've got a death benefit of $250,000. Hey, we've got enough to cover the mortgage. We're overfunding this IUL, so we always have the $250,000 of coverage in the event of an early death. But if we look here, year 21, our cash is projected to have grown to almost be able to pay off the mortgage balance. In fact, you're close enough you could probably just cut the check right then and there, and with your extra funds pay it off. We certainly have enough by year 23 to pay that off and then some. And of course, the nice thing about this concept is a client doesn't have to do this. They could choose not to pay that mortgage off early, continue to just pay it off over time, and now they've got a nice little supplemental retirement fund going for them there. By year 30, we've got $230,000. Hey, maybe they sell their home and use this extra money here to buy a newer and bigger home, and it can be completely paid off at that point in time. And we can also see what that money would continue to grow to over time. You know, year 50, we've got about $1 million. This could be supplemental retirement income if the client doesn't choose to use it to pay off the mortgage. So a lot of flexibility for your clients there if they've got the cash flow to do this. Now, let's say your client doesn't have quite that much cash, but they would still like to pay off that mortgage early. They really like that concept. Well, let's look at a return of premium life insurance policy here. And here's our assumptions that went into this. I ended up using a 25-year return of premium from American General on this. They have just fantastic rates for their return of premium. And here's how this works. So we start off with the $250,000 mortgage. Death benefit, I had to raise it up to $280,000 to make it work in this situation. But you know what? That's okay. There was never a widow or widower I've heard of that complained about getting too large of a death benefit amount. Now, with return of premium, we know that at the end of the term, the client gets all of their premiums back tax-free. Well, with a lot of carriers, you can get some of your premiums back early, and that's what that second line depicts there. Year 16, we owe $148,000 on the mortgage. If we choose to cancel a policy then and there, we're eligible to get back $16,000. Now, that's nice, but you know what? That's not going to pay off the mortgage at that point in time. So we better keep continuing to pay this. Year 21. Now we're up to $33,000 built up. Well, still not enough to pay off the principal of $103,000. We're getting closer though. And finally, at the end of year 25, we've got $49,000 and change. Our principal balance is $50,000 and change. I think they could dip into their savings, make up the difference. We've now got enough to pay off that mortgage 5 years early, and we didn't have to put all the money into an index UL policy and overfund it year after year after year. All we did was purchase a simple return of premium term policy here for this client, and I thought I had the premium amount in here on a slide. I guess I didn't put that in there, but you can just take the $49,560 divided by 25 and find the annual amount. So those are the three concepts, and these are all designed to set yourself apart from your competition in the mortgage term arena. You can help your clients save money by lowering the premiums. You can provide your clients with money through living benefits. And you can also help your clients make some money and pay off that mortgage a little bit early there. And I'd like to turn this, actually, before I turn this over to questions, the other component here would be finding clients for these concepts, because these sales ideas don't do you any good if you don't have anybody to talk to. The first place you should be looking at would be your client files. This is where the majority of the sales are made for all the applications I see come in the door, and it'd be a real simple task to call up your clients, send them a letter, send them an email, and ask them if they've been able to take advantage of these record low interest rates and refinance their mortgage sometime in the past several months here. And I tell you what, if your clients have been able to save money, they're going to talk to you about it. People love to brag about how much money they saved on anything that's out there, especially if it's their monthly mortgage payment. So you'll get the full story from them, no doubt. Now, if your client's been able to save money, they've probably been talking to their friends about it, again, because people love to talk about saving money and how smart they were for doing it. They probably have some other friends who have done the same thing or who would like to do the same thing. Don't be afraid to ask for referrals of other folks that they know that have done that. And if you're not using social media in your marketing right now, you need to get started. You're actually behind the curve a little bit here because every other business in the world has caught on to this a long time ago. It would be really easy to post questions like this out on your Twitter account, on your LinkedIn account, on your business Facebook page. Put a small little paragraph about it on your blog. Make sure that your clients and their friends know that this is something you can help people with. Now, if you'd like to spend a little money to bring in some new people, we do have our Leads on Demand system. It's available on our website. It allows you to go out and choose whatever demographic you want. You'll be able to get their names and addresses, some cases phone numbers, but this is meant if you want to conduct a mailing campaign to generate interest. And you could also use the online prospect finder system, and with this you can conduct an email marketing campaign to do the same thing. Choose your demographics and see what kind of interest you can gather there with Prospect Finder. So see if we have some questions that have popped up. I would like to thank everybody for joining us here this morning for Refinancing Mortgage Insurance, a new look at an old concept. And be sure and catch next month's webinar. We'll be discussing linked benefit products in a lot more detail, discussing why this is one of the fastest growing markets in the life insurance industry today. So thank you for your time, and if you have questions we couldn't get to this morning, feel free to give us a call at 800-475-5555. My extension is 3371, or ask for anybody in live marketing. Have a great day.